It's certainly true that compared to the worst of the worries that we had, let's say, economically in terms of the UK and Europe, that we've gone from really quite terrible to less bad, and energy prices, I think would be a good example of that, had been a major headwind in prospect, and it's just turned out to be not quite as bad. But I think we do need to put this into perspective, and I still think it is going to be quite a challenging period for corporate profitability. It does feel as though the balance of what we're hearing from companies, it's not disastrous, but it certainly doesn't have that positive ring that I think we've had from the last few quarters, where, in a sense, people were looking for where the signs of recession were. I think there's probably a few more of those coming through now in terms of the balance of risks, certainly in terms of slowing revenue that you're getting from some surprising quarters. So in that sense, I think we need to position accordingly and say, look, this doesn't feel like it should be the start of a multi-year bull market in stocks.
Before we get into the weeds a little bit more, you've got some views on the BOJ, and with that, is there an opportunity for our viewers?
Well, I think so. What was quite interesting, I think, in terms of the on-hold decision from a couple of weeks ago was that there was certainly a pullback. But then I think if you look at, for example, where the yen moved to, where Japanese government bond yields moved to, they were actually fairly stable after that initial move. And I think what that really suggests is the Bank of Japan is just postponing the inevitable. I think what's really interesting about bond markets globally right now and interest rate forecasts is it's a little bit difficult to pick your way between the downtrend in inflation, the peaking of interest rates that we mostly expect, and maybe a bit too much optimism about rate cuts in the back half of the year. The picture is a bit clearer in Japan because they've held policy on hold for so long. And so you have the situation where there is a need for policy adjustment, not because of a collapse in the currency, but actually because of what's happening on the ground. So we're seeing companies, forget the next round of wage bargaining, even against the last round of wage bargaining, we're seeing companies saying, look, actually, we're going to pay more than we committed to. And we haven't really seen that in post-bubble Japan, so that's really 30 years of history. And I think that's a really important change. Now, what does it mean in terms of the opportunity? I think for us it does mean that the yen should be one of the real winners from this through this year, and I think it will be one of the big themes in currency markets. And equally, if we're looking for places to take positioning in bond markets, it does feel as though Japanese yields, particularly at that targeted 10-year point, there's only really one way for them to move in our view.